This video will introduce you to the concept of hidden divergence. In this video, you will learn what hidden divergence is, the different types of hidden divergence, how you can find hidden divergence, how you can trade with hidden divergence. While divergence can provide insight into a potential market reversal ahead of time, hidden divergence can provide insight into the potential trend continuation ahead of time. You are looking for divergence between price and the indicator. However, with hidden divergence, you are looking for the opposite set of signals to normal divergence. Hidden divergence works much in the same way as standard divergence in that it compares price action on the main chart to the movement of the indicator. The two types of hidden divergence found are called bullish hidden divergence and bearish hidden divergence. In this example, we will look at bullish hidden divergence. When price makes a series of higher lows in an uptrend, but the indicator makes a series of lower lows, it is called bullish hidden divergence. This is a trend continuation signal that normally precedes price moving in the same direction, potentially setting up a long trade. The easiest way to look for bullish hidden divergence is to first look for a market that is in an uptrend. From the chart example, we can see price making a series of higher lows denoting an uptrend. The indicator, however, is making a series of lower lows. There is hidden bullish divergence between the price and the indicator. The market direction then continues with the uptrend. In this example, we will look at bearish hidden divergence. When price makes a series of lower highs in a downtrend, but the indicator makes a series of higher highs, it is called bearish hidden divergence. This is a trend continuation signal that normally precedes price moving in the same direction, potentially setting up a short trade. The easiest way to look for bearish hidden divergence is to first look for a market that is in a downtrend. From the chart example, we can see price making a series of lower highs denoting a downtrend. The indicator, however, is making a series of higher highs. There is hidden bearish divergence between the price and the indicator. The market direction then continues with the downtrend. Once you've spotted hidden divergence, you should also know what type of trade to look for. If price action is making higher lows, but the indicator shows lower lows, you are most likely seeing hidden bullish divergence. When this happens, you should look for buying opportunities. If price action is showing lower highs, but the indicator shows higher highs, you are most likely seeing hidden bearish divergence. In this case, you should look for selling opportunities. It takes practice to spot hidden divergence. It is recommended that if you are new to this concept, you should concentrate on standard divergence first. Once you are used to finding standard divergence, you can then incorporate hidden divergence into your trading at a later stage. There are some key points to remember when trading hidden divergence. For one, the time period is relative. The higher the time frame you observe hidden divergence on, the longer it may take for the trend continuation to actually happen. Secondly, the higher the time frame, the more reliable the concept is. This is not to say that hidden divergence cannot be used on lower time frames, but it pays to be a little more cautious. Hidden divergence can be helpful in preparing to enter into a trend early on, but it must be combined with a strategy defining the entry, stop loss, and profit target. A way of using hidden divergence with a strategy for trading is to combine it with multiple time frame analysis. You can look for hidden divergence to spot an upcoming trend continuation on the higher time frame, and look to the lower time frames for an entry using a simple trend line break. This can give a trader a low-risk trading opportunity to enter into the higher time frame trend. So far, you have learned that hidden divergence helps to determine the continuation of the current market direction ahead of time, and it can be a powerful tool to enter into a trending market. There are two ways to find hidden divergence, either by looking for higher lows on the price chart and lower lows on the indicator, or by looking for lower highs on the price chart and higher highs on the indicator. On a higher time frame, it may take longer for the trend continuation to happen. However, the higher the time frame, the more reliable the signal is. To find entries, divergence can be combined with multiple time frame analysis.